Good evening, everyone. My name is Chris Gaetano with the New York State Society of CPAs Trusted Professional, and thank you for joining us here at the New York State Society of CPAs for the new peer review law, What Sole Practitioners Need to Know. I'd also like to thank those of you joining us on the webcast and via Periscope. On October 23rd, Governor Cuomo signed into law new legislation requiring that all practitioners doing a test engagement, regardless of size, have their work peer-reviewed every 3 years. This means that sole practitioners now join all other CPA professionals doing a test work in New York who have been required to undergo mandatory peer review since 2012. This has led to many questions from the sole practitioner community about what exactly this means and how sole practitioners should respond. Here to discuss what sole practitioners need to know about the new law, we have three members of the Society's peer review committee: Grace Singer, Ray Nowicki, and Ira Talby. Grace Singer is the partner in charge of the Quality Control Department of Burnton LLP. She performs technical reviews of test engagements, provides consultations and staff training on technical issues, updates the firm regarding new technical pronouncements, and assures that the firm complies with all professional and regulatory quality control standards. Ray Nowicki is the managing partner of Nowicki & Company LLP in Buffalo, New York, and the CFO Vice President of Digits LLC, an IT forensics and e-discovery company. He also served on the AICPA Peer Review Board from 2002 to 2004 and is the author of 2 AICPA National Training Manuals on peer review. Finally, Ira Talby is the Quality Control Partner for Prager Metis CPAs LLC, where he is responsible for all quality control functions. He specializes in a full range of audit and accounting services, as well as tax consulting services, with more than 30 years of experience in various industries, including investment companies, real estate, trusts, and closely held businesses. Again, this discussion is being streamed live on Periscope with the archived footage available on YouTube shortly after. The presentation will be about an hour long with plenty of time for Q&A afterwards, so we ask that you please hold your questions until the end. Now, let's get started. I guess the first thing I'd really like to ask you is that now that this law is passed, who specifically is obligated to undergo a peer review? Who does this apply to?
New York State has specific rules with regard to who is required to have peer reviews. And the definition basically is anybody that performs an audit. And an audit includes government audits, ERISA audits, and even the New York City certiorari audits that people do. Any review of the financial statements, any examinations that are prepared, and any engagement performed in accordance with the auditing standards with regard to the PCAOB, the Public Company Accounting Oversight Board. What this doesn't include, it doesn't include compilation reports. If you're only doing a compilation report, you're not under peer review standards, so you do not have to undergo peer review standards, and there's no reason for you to be here today. But you know, it's very easy though for practitioners to get confused about the type of service that they're doing, and that's one of the things that you really have to understand in order for these rules to actually make sense to you.
Now, this is not an issue that came out of the sky on a clear blue day. Since peer review became mandatory in New York State, the State Education Department has been recommending that sole practitioners be required to undergo peer review. Why is that? And then also, too, why was the State Society on board with this initiative?
Well, for a lot of different reasons. Originally, when the law was changed, it actually scoped out the sole practitioners in the law. And that was one of the reasons that was given by the state for actually going into this was Bernie Madoff. And as we all know, Bernie Madoff's accountant was a sole practitioner. So that was one of the issues that we had with it to begin with. The other thing is we've been under a lot of scrutiny from all the different regulatory agencies that are out there, particularly the DOL, on a yearly basis, almost an annual basis since this law actually came into effect. They've been putting out their hit list of all the inadequacies that they found in their review of files. And they've also hit on peer reviewers that have not picked up these inadequacies in all of these other audit engagements as well. On another level, there have been problems, we had the Roslyn School District, Enron, all of those other areas too that have had an issue. And the other thing is, New York State has lagged in this particular arena. Most of the other 49 states already have a mandatory quality review standard that's in place. So we are probably the last state that's adopting it.
So then, what if then I just move to another state? What if I just change my practice makeup? Would that be a way to avoid being captured by this new law?
Well, I guess it might be said that if we're the last state in the union to have mandatory peer review, where are you going to move? I kind of like Ira's idea is move to a state of retirement is one state that you could move to, because that's about the only way to avoid being captured by the law. And I believe that generally speaking, this is something that you should almost be ready to embrace, especially if you're doing reviews or audits, because the public trust is at risk, and that's the perception. That is the situation that we're in now. Regulators across the board are giving serious thought to finding another way. They like peer review so much, they'd love to take it over. You have a choice. Do you want to be a firm that does not regulate itself? Would you like to be a profession that gets regulated by a governmental body like, say, the IRS or the state sales tax auditors, creating their own version of peer review? Or who might do this? It's an onerous task. It's been around for more than 31 years. I've been involved in peer review. Our firm, just to give you a little background on our firm, and a previous firm, we started getting involved in peer review in 1980. When it was purely voluntary. Then it moved to a mandatory program, if you remember the AICPA, in 1986. So many of your colleagues in the profession have been undergoing peer reviews. Our firm has undergone 11 peer reviews since 1986. And generally speaking, it seems to be time where everybody else has to jump back in the pool. Now, if there's another point up there on the board that you might want to, can I change my practice to avoid being captured by the law? Well, yes, you can. Don't do any attest work. Don't do any reviews. Don't do any audits. Don't do any certiorari. Do compilations. Do, quote, preparation engagements, which are one step below the compilation. There's no assertion in those types of engagements. And avoid being peer reviewed. Those are considered to be very, very low-risk engagements. So that's an alternative to just going out and saying, I want to completely get out of the public accounting arena. Or you can just do tax work and consulting. So that's a thought. What else have you got for me?
Well, okay, so let's say that after, finding out all that, I still believe that's all a load of hooey. I want to keep on doing just what I've been doing this whole time. I mean, look, what if I just ignored this law? What is the worst that could happen?
I don't know for sure what will be the worst that the State Office of Professions will levy as a fine. I can tell you that I've read, I make a point every year of looking and seeing what the Office of Professions is attacking, if you will, or what they are, what areas of the accountancy law they are enforcing. And historically, they would nail firms for DWIs and tax fraud and stuff like this. Just in the first half of this year, 20%, 22% of the cases that were adjudicated dealt with firms who had done substandard engagements on pension plans. And each of the firms that cases I reviewed got fines levied against them in the $200 to $2,500 range, plus continuing education, and in some cases being forced to give up those engagements because they were not qualified to do them. I have also seen an incredible uptick in the number of cases being adjudicated dealing with failure to comply with the continuing education rules of the state of New York. Out of, I think that was something like about 12, 14% of the cases, firms that just couldn't prove their CPE was right, and they're doing more and more testing, compliance testings. QROC, the Quality Review Oversight Committee, and the Accountancy Board are reaching out to practitioners and asking you to prove that you've at least met that educational requirement. So I would say, if you're going to be in New York State, expect to face the full range of punishments, not just CPE, but also possibly fines, possibly suspension of your license, possibly publication. It's an embarrassing type of thing to face, and also costly, because they don't just come out and hit you with it. First, there's an investigation, and that investigation will eat up more billable time than you can shake a stick at. So they have the power to do that, they have the legal right to do it, and they are doing it. So I would say it'll take them a little bit of time, maybe a year or two, to kick in the enforcement action, but eventually practitioners will feel the force of law against the CPA. So.
Okay. So, right, I would need to get peer reviewed then. What exactly does that involve, broadly?
Okay. Well, there are two types of peer reviews. If you're only performing reviews and compilations and preparation services, that is an engagement review. If you're performing audits, you must have a systems review, which obviously costs more, because the systems review is actually looking at your whole QC system of internal controls, so to speak, as opposed to just looking at how you performed on that particular engagement. And you would give a census of how many engagements you have that are reviews, compilations, and then the peer reviewer would pick from there. Then there's also a risk assessment of your firm and the engagements that you have. Obviously, if you're doing work that's in the public interest, such as work for the DOL, work for HUD, any kind of work in the now Uniform Guidance used to be A133, the Single Audit Act. Those would all be work that's considered in the public interest. Even co-ops and condominiums, if you're doing work for them, they're also considered in the public interest. So those are things that would be taken into consideration. And how many of those jobs you do would also be taken into consideration. Because if it's a lone job or an outlier for you, and that's not in your experience level, that could add to the cost of the peer review. How prepared are your jobs for peer review? Do you have all your documentation? So when the first law came into effect, actually, I was on an oversight of a firm that did a tax certiorari audit. And we were very surprised when we went down there to do the oversight. This firm, and that was their only audit, and it was only one tax certiorari audit that they did, but they gave us a file that was so comprehensive that we couldn't believe it. It actually took us about 3 hours to try to get through a file that was that comprehensive. So it also depends on how well you're prepared, all right? And I'm not saying don't put the documentation in, put the documentation in, because it gives your peer reviewer a warm and fuzzy that you know what you're doing. How much your firm supports the QC process. Do you go out and buy quality control materials that have been peer reviewed? Or are you doing your own? So in the particular case of this firm, they actually did their own memos, and they were quite comprehensive. The man sort of understood what he was doing, but that was just for a tax certiorari. If you're doing different industries, you know, I would recommend that you would get a quality control materials that have been peer reviewed to have something to follow along. So that does add a cost to your peer review. That's not a cost of the peer review, it's just a cost of your quality control system. The other cost is, where is your practice located? Is it in the big city? Is it in the local towns? And also, are you going to get your reviewer from the big city, or are you going to get your reviewer from the local towns? That's a different scheme there? Do you want somebody that's in the same neighborhood as you are because they're a potential threat to take your clients? That's another consideration when you're thinking about peer review. And then it's the attitude that you have towards the peer review as well. Is it really, I'm being forced to do this? Or are you going to be participatory in it and, you know, look at the educational value of it? My firm went through a review of the PCAOB, which if you want one of the regulators to take over, that's not one of the regulators you want to take over the peer review process, all right? They had more people examining the review than we, the actual audit client that we actually had on the audit client to begin with. So it's a difficult process, and we want to get out of having one of the regulatory agencies taking this process over.
I want to go back to cost now. So thinking in terms, let's say, of a firm that's never had to do one of these sorts of things before, generally, how much will this cost that kind of practitioner? What sort of costs are we looking at here?
I mean, we've come up with a couple of different estimates
You might
here.
wanna move the slide.
You know, we were saying that, you know, in an engagement review where the quality control of the firm doesn't actually have to be reviewed, they were just reviewing specific engagements. You know, a cost on that for a New York City firm could be anywhere from $2,000 to $4,000. And if you're upstate, maybe it's a little less, it's $1,000 to $3,000. That's just on an engagement review. There's other costs involved, which we're going to go over in a few minutes also. If you have doing a system review, which has to go through all of the quality control elements within the firm, we're estimating that it can be anywhere from like $4,000 to $5,000 if you're in the city, and that could be even less depending upon depending upon whether or not your firm is ready for it or not. The more your firm is ready for peer review, the less your fee is going to be. And that fee upstate could be anywhere from $2,500 to $3,000. Additionally, above your peer review fee, there's two other fees involved with this. There's an annual administration fee that the state charges, and we've listed those here. For a sole practitioner, you're talking about, for an engagement review, it's $269 for the administrative fee on an annual basis, and for a system review, it's $411. For firms of 2 to 5 professionals, it's $345 for the engagement review, and it's $487 for system review. In addition, when you actually go through the peer review year, you have an additional administrative fee that you're going to have to pay as well. And that's to cover basically all of the administrative responsibilities to get your peer review through the system.
Okay, so how exactly does someone register for something like this, and when do you register then?
You want me?
Yeah, if you don't mind.
Okay, I don't mind. Actually, I got a question beforehand about this. So when do you register for this? Actually, the way the law is now written, if you were in the middle of doing an at-test engagement when the law became effective, which was October 23rd, you have 30 days to register with one of the entities and notify SED that you need to have a peer review. Then you need to pick your peer review date, and you need to enroll with a particular peer review program. Right, so you can enroll either with the AICPA, or you can enroll with any of the administrating entities that are out there. The New York State Society is still an administrating entity up until March 31st. And March 31st, we're transferring our peer review function, our administrating entity function, to the Pennsylvania Institute of Certified Public Accountants. So they're going to be taking it over then. But there are a lot of different administrating entities throughout the country that you can choose to administer your peer review. It doesn't necessarily have to be the AICPA or the New York State Society, or even Pennsylvania for that matter. There are, I think New England has a setup where it's a couple of states that are together there. But you have the 30 days that you have to notify SED that you've been involved in test engagements from October 31st.
Let me clarify something that was brought up. We're talking about the peer reviewer's fee and then the administering entity's fee. And we're talking about, well, why do they need money? And here's basically what happens. Once the peer reviewer has completed his or her work, the peer review file gets submitted to something called a report acceptance body. Namely, it's from a given administering entity, a given state. There may be anywhere between 3 and 5 other CPAs who are trained peer reviewers, quality control people, who have an obligation to review the work performed by the peer reviewer and give it the once-over to see if it holds together, if it has integrity, and whether or not all the aspects and standards associated with peer review have been met. It also undergoes, prior to that, a review by at least one technical manager from the given state, in, say, Pennsylvania for the sake of discussion. In the remote chance that anybody in the room is doing broker-dealers, you have a slightly different path because the review is done by the National Peer Review Committee, and it undergoes a review by 2 technical managers from the AICPA at a bare minimum, and then anywhere from 3 to 5, a subcommittee of 3 to 5 people, or, you know, in the really large firms, we sometimes have to convene the whole committee. So there are, and why do we have that secondary review process? Well, checks and balances. It's try to make sure that the peer review team captain isn't selling his signature. It's as simple as that. Is all the work there? Is the proof there? Does the process have the integrity with the particular firm? And also, because this on another slide, sometimes a firm may say, I see the report I just got. I don't like it. I don't believe it. It's not fair. It's not right. And here's why. Who do I appeal to? Well, that administering entity, that report acceptance body, can act as an independent arbiter between the team captain and you, so that you have a second for the apple if you don't think you've been treated properly. You know, it's funny because we're talking about the preparation for peer review as though that's a separate function from doing the audit. And the fact of the matter is, 90% of the peer review is based upon how well you audit, how well you document what you audit. And when we talk about common deficiencies, I'm sure the 3 of us are going to be able to throw out a lot of deficiencies in the audit or in the reviewed financial statement that are the problem causes. And quite honestly, the more problems there are identified on engagements when we look at them, the more likely it is that the cost of your peer review will actually increase, because that means the reviewer, the technical person that you've hired, has to write up more findings, and writing them up takes time, and time is money. So keep that in mind as you look at that. Oh, what's the next comment?
Well, basically, where exactly do you find a peer reviewer?
We have, you can contact the administering entity, in this case, the New York State Society of CPAs, or the Pennsylvania State Society of CPAs, and they will be able to get you to peer reviewers who are technically qualified. Or you can go to the peer review website, go to aicpa.org. Excuse me, that's your starting point, and then under areas of interest in that particular website, you scroll down to peer review, and then there's a section for firms, and that section for firms will lead you to on the system called Prima, the listing of available peer reviewers. Let me talk about identifying peer reviewers, because again, I've been involved in this program since 1980, and way back when when I had more hair and a smaller belly. Way back when, there was a paranoia in the profession about, well, I don't want to pick somebody from my own city, my own town, because they're going to know. They're going to know what I'm doing wrong. Well, the peer reviewers, by and large, have almost a priestly duty of silence. They're not supposed to walk around and say, hey, guess what Harry did? I have found that over the past 30, my gosh, what did I say, 1980?
You started
over the past
in 80.
37 years.
My whole career.
Yeah, over the past 37 years, the community, the profession has gotten a little bit more relaxed. So don't relax in the sense of not fearful of picking a competitor to do your peer review. So think about that, because again, these peer reviewers are charged with an ethical duty. And what are they really going to do? They're going to go to your client and say, guess what I found out about Joe? Not likely. That would be the last time they ever did a peer review. And quite honestly, one of the practical considerations, if you're worried about that, is have them put specific language in the engagement letter. It's a contract. It says, that says they will not, under any circumstance, promote relationships with clients that they determine are clients of your firm as a result of this peer review engagement. That, if they give you their word, they'll keep it. So, that's one of the things you need to do. And where do I find the peer reviewer? Once you found names, then you have to go through a screening process. You want to avoid picking a peer reviewer that's a mismatch. But what's a mismatch? In the early days of the program, there weren't a lot of peer reviewers. So the people that were the qualified peer reviewers either worked for national firms or huge firms, or they had disengaged from national firms and went off on their own, but they had again, we used to call it Big Eight firms, now it's the Final Four. The Big Eight firms, they had a Big Eight attitude, and so that was a mismatch for a sole proprietor like our firm. When I started having our firm's peer review done initially, when I broke off for my own firm, I was a sole proprietor with no staff. Well, the best I could do was to find a practitioner who was from a 50-man firm, and his prices were a little bit higher than I would have liked. That was a problem. And his thought process was the processes of a big firm as opposed to a sole proprietor with no staff. That is what I call a mismatch. And we worked through our differences, and that was the beginning of the program. Today, there's a large database. I think in New York, I believe there's something like maybe 200 peer reviewers registered in our database, and 100 of them are fairly active. The other 100, I'm not so sure about. But out of the 100 active, you could certainly find somebody who's, probably close enough so you're not paying for overnight travel. You might be able to find somebody who is comes from a two-partner firm. Maybe there's a few sole proprietors. Grace, didn't you just mention that some of our peer review committee members were sole proprietors?
Yeah, we've had quite a number of peer review committee members that are sole proprietors that actually volunteer and work on the RABs, the review acceptance bodies, and are part of the committee. So you can find peer reviewers that are sole proprietors all the way up to the Big Four. I think they're still doing them, but not for anybody other than Big Four or national firms. But I wouldn't suggest that, believe me. I used to be with a national firm. I used to be with a Big Four, and those peer reviews were not fun. But you do want to find somebody that understands your particular industries, your particular niche, understands what you go through on a daily basis with your clients, and that understanding does come from a sole proprietor that's working out there.
Okay, so from what I hear about peer reviews, they result in either a pass with deficiencies, or a fail. What exactly do those mean? What's the consequences of getting, say, a pass with deficiencies? What's the consequences of a fail? What happens?
Well, basically, the peer review terms have been changed over the last couple of years, and they made it easier for people to understand what the requirements and what the outcomes of peer reviews were. You can either get a pass, which means that you've done a great job. They didn't find anything wrong with you. They may have found some things that they've written up, but they wouldn't affect the outcome of the peer review. They may have passed with deficiencies. You may have certain problems within the firm that they want to highlight, so you can't get a pass, and then you might have a fail. Fail basically means that nothing that you've done there pretty much is in compliance with the standards. And we do have one other option, basically, which is you got to evaluate your business model to see whether or not it makes sense at the end, before you get this fail, whether or not you should actually be in the program or not, and whether or not you should be doing a test work. So
Many times when we have firms that come back to us and they've gotten a pass with deficiencies or a fail in a particular area, they'll say to us that they're no longer going to do employee benefit plans, for example, okay? That's usually an area where we see an awful lot of the pass with deficiencies and the fails occurring. The other thing is the understanding of CPE, which Ray brought up a little bit beforehand, whether or not the firm's gotten the correct number of CPE. So sometimes, and these things are all aggregated together. So the findings all come together. It's sort of like when you're doing an audit and you do what's called a SAS 115 letter, where you're documenting all the deficiencies in the system. You take them all together and see where you wind up. Sometimes they're cumulative and they keep adding on so that you get a pass with deficiencies, and then you wind up at a fail.
I mean, part of the problem too is that some practitioners have done audits for 30, 40 years, but they haven't changed the way they've done audits, and the standards have changed though. So that's going to cause you right off the bat to probably have problems on your peer review. A lot of practitioners, especially the smaller practitioners, do a lot more work for their clients than, let's say, the larger firms, and independence issues could come up when you're doing those type of jobs. You're doing write-up work for clients, and the client doesn't have the wherewithal to basically understand what you're doing, and you're just telling them that this is the way it's supposed to be. Well, that's an independence problem. We've seen practitioners that haven't met the CPE requirements under New York State, which is the 40 hours of AAA over 3 years. That can cause you to have problems on your peer review.
Let me give you some math and history. I reviewed and I generally review the annual oversight report published by the AICPA. And my best recollection, I haven't looked back this far, but I remember writing an article on this topic. Between 86 and 91, the percentage of firms undergoing peer review that either got what would be equivalent of a pass with deficiencies or a fail was in the neighborhood of 20 to 24%. The percentages, and that's all right, so you got a 1 in 4 shot of getting a bad report. It doesn't sound so bad, does it? It sounds like the odds are stacked in your favor. And in fact, from the 90s going forward, as firms were getting used to this peer review process, the number of engagements, number of peer reviews that fell into the lower two categories actually started to decline. They were in the 10 to 12% range. So firms that had volunteered for this particular endeavor of quality control and committed to it showed definite improvement, and it was a great thing to see. But there's something that's never published. It's not really known to the community. I was a young peer review trainee learning how to do peer reviews, and I went to the National Peer Review Conference, and the guy who was the chief overseer, Gary Freundlich, who still is the chief overseer of the peer review technical side, said something that I never thought I'd hear him say. He said, Ray, guys, ladies, this peer review process is new and it's voluntary. He says, so what do you do when you find a lot of mistakes? He says, well, you don't want to beat these guys up on the first go-around. Try to find a way to find the happy middle ground. That was then, and now let me tell you about now. Gone. The pressure that is now put on team captains to do the right thing is so significant that there is no softer, kinder, gentler way. And I will tell you that your firm will live and die by the merits of the audit and review work that you perform in accordance with professional standards. You're either doing it in accordance with standards or you're not. I'd be glad to take a survey here, but I'll tell you my best guess. I believe that firms who have not seen the light of day of a peer review in the past 10 years, we're probably going to see every bit of a 35 to 40% failure rate. And I say failure rate, that includes pass with deficiencies and fail. What do you guys think? What do you think we're going to have in failure rates or PWDs?
It depends on the firm itself, I would think.
Well, yeah, it does.
If the firm really wants to do the right thing, they're going to do the right thing. If the firm thinks that I know the numbers are right, I can just throw it through, those are the ones that are going to wind up with the fails, because there's going to be something in their documentation, and 99% of the time that's what this comes through. It's just not going to be there, and if the documentation is not there, it's if you never did it. So.
Mm-hmm.
And you've got to remember, I mean, today I was prepping my co-managing partners because our peer review is next week. And I turned around to my co-managing partners and said, you know, some of those documentation things that you thought we could get away with, we're probably not going to be able to get away with in the future. Because if it isn't written, it's not done. And that's the way it is, you know. So every level of firm struggles with this. And as Ray was saying, this has evolved. So unfortunately, you haven't been on the evolution with the rest of us. So you're playing a severe game of catch-up. With that, you know, it may pay to have a pre-review done before you get a peer reviewer in, so that you feel what the deficiencies may or may not be in your engagements. And there are plenty of people out there who will be consultants to smaller firms to help them out to get ready for a peer review, or to even get some suggestions on what to do, you know, in the quality control arena, what practice guides might be the best for you, things along those lines. But, you know, I don't want to make it sound that, you know, documentation is the key these days on peer review. That's what we heard at the peer review conference. And, you know, it was from everything to independence issues, whether or not your client had the skills, knowledge, and expertise to be able to accept all the non-attest services that you were doing. All of these matters, you know. And as I said before, I was on an oversight with the technical manager from here, and we went off to look at this tax certiorari and said, there's no way this man, he only did one, reported it, and got a pass on his peer review when we all didn't believe it. And we went on down to look at it, and he really hit it out of the ballpark. He really did a good job. So it all depends on your tone, and your tone at the top. And you are the top. That's it. You're it. The buck stops with you, even if you've got a couple of professionals at your firm. It's really up to you if it's going to be a success and you get a pass, or if you're going to get a pass with deficiencies or a fail.
I mean, one of the first things a peer reviewer is going to ask for when he walks in the door is your quality control manual. And most smaller firms don't have that. So they have to create it from scratch now. So, I mean, it's going to take time for you guys to get what you're required to even get before you even start the peer review. So,
Let me do a quick survey of the room, and I know you folks in Cyberland can't participate, but of the people in the room here right now, how many of you have a reviewed financial statement as your highest level of service? Raise your hand. Only one. So the rest of you have audits as your highest level of service. So there was a reason I asked that question. If you have a review as your highest level of service, you qualify, and we talked about, an engagement review. An engagement review, it was shown to be less costly. So you sit there and say, and guess what? And the great thing about an engagement review is you don't have to have somebody go through and look at your quality control document. They don't have to look at your CPE. All they got to do is look at your financial statements and your and your underlying work product, right? Sounds pretty good. Sounds like it's the easy pass of peer reviews. The fact of the matter is that there were a few years recently where there were changes in standards where the failure rate on engagement reviews were somewhere in the magnitude of 40 to 50%. Why? Because when you undergo an engagement review, the rules are much more stringent. The peer reviewer looks at 2, maybe 3 jobs. They're pre-selected by you more often than not. And what you submit, that's it. We're not caring about your system of quality control. We don't care why the dog ate your homework. There's no room for excuses. It's simply, here's the work. They blue pencil it. It's either right or it's wrong. If a firm in an engagement review has a couple of significant errors among, say, a major misdisclosure on a reviewed financial statement, say $1 million line of credit that's outstanding, but there's no report of interest rate or collateral, right? A reviewed financial statement that we forgot to get the engagement letter and we forgot to get the representation letter, or it was dated improperly or something like that. There's no opportunity for the peer review team captain to expand scope. So the engagement review now becomes your worst enemy. However, to Grace's point, you could get someone to step in, look at a few of your engagements that are likely to get picked, have that technician, that quality control person, point out areas where you got to clean this stuff up before it goes to go through the peer review process. That's fair play. That's not a problem. Okay. The systems review, more expensive, more comprehensive, and you do get an opportunity to explain why the dog ate your homework. You get something better than that, because remember, in an engagement review, the team captain cannot expand scope. Gee, I didn't get a representation letter on this reviewed financial statement, but I did it on my other 4. Don't care. What you gave us, that was the sample. We can't expand scope in an engagement review. In a systems review, the peer review team captain is allowed to expand scope and to say, yes, this was an isolated incident. They made a mistake. It was a material mistake. It caused an engagement to be not in conformity with professional standards in a very important area. But it was a one-of-a-kind mistake, and we can see that the firm has a system in place to correct itself and to catch the error, and it didn't do that a lot. So this is why in a systems review, there's an opportunity to avoid a pass with deficiencies. Let me give you another comment. And I served on, right now, not on the AICPA peer review board, I serve on the National Peer Review Committee. We review the peer reviews of the Big Four and the 100 largest firms in the country, and it's a very onerous task. And sitting next to these 16 other professionals, and they're really the cream of the crop, it's an honor to serve with them. We had a discussion one day about what's the difference, how do you know when to give a firm a pass with deficiencies versus a fail? And there is a plethora of professional standards written on how to discern whether one deserves a fail. I will tell you what I told them. When I'm the peer reviewer, and a firm's got a lot of mistakes, but they're willing to correct the errors of their ways, they're willing to improve, they really got their heart in the process, they want to do better, they don't want to go down a slippery slope. And they tell you that, and they respond to the findings with dignity and decorum and professionalism. I make the case for a pass with deficiencies. When a firm tells me, and again, after well over 30 years of experience, when a firm starts copying an attitude and telling me I don't know what day it is and I don't understand professional standards and the system is all screwed up and you guys are a bunch of idiots. I mean, some of the language can get pretty rough sometimes. And it's been rare because we have a very kind, forgive me for saying gentlemanly profession, but we do. And there's a lot of dignity in the room here. But on occasion, I'll get somebody who absolutely goes ballistic, thinking they're going to yell me into a backing down from a PWD, and what they're screaming and ranting creates is a tone at the top finding, which is, in my mind, basis for a fail. So demonstrate decorum through the process. Demonstrate a desire to learn from the process, because if you haven't gone through a peer review in a long time, there are guys have been doing it for 31 years now, so or longer. So you got to play a little catch-up ball and either get somebody in, to correct the errors of your ways before the peer review starts, or don't and take the result for what it is as an opportunity to improve, and even consider going through an accelerated peer review a year or so from after that, so you can demonstrate that you have improved. And that's really what it's about.
I mean, one of the other things you got to consider too when you're doing your engagements, if you're coming up with a lot of additional steps that you need to do that hadn't been done before, you got to look at the pricing of your jobs and see whether or not they really make sense based on the work that you need to do. I see a lot where you get people coming in bidding low prices for engagements, and the truth is that you question whether or not they're actually doing the work that they need to do, because I know for a fact that there's no way they can get that done for that price. So
that same practitioner that we went out and did the oversight for the tax certiorari turned around to us at the end of the day and said, there's somebody out there that's selling this for about $500. And he said, there's no way that this audit should cost $500. And he turned around to his client and said, good luck. Go out to the guy that's going to do it for $500. I'm just not going to do it, because his tone at the top, he was a very ethical man. I mean, we were amazed by that. But just keep in mind that they're all catching up to this. The tax certiorari, the tax commissioner actually had me speak to the bar about this particular issue last year. And she turned around to those attorneys and said, keep in mind that your CPA that's doing that audit report is technically your expert. And your expert better be able to muster up a peer review report, and better have a peer review report that is a pass. So she's looking at ways that she can do what the DOL did with the AICPA. She wants to do it with QROC, is to make sure that the firms that are giving her these tax certiorari audit reports are registered for peer review and are meeting the standards.
I mean, I also wouldn't be surprised. We just had underwent a DOL audit, and one of the questions that they ask on the information sheet is, what were the fees that you charged for this audit? And they're going to look at this and say that if you charge $2,000 for a DOL audit, chances are you probably didn't do what you need to do. And that's going to be the first response. You've already got a black mark against your name because of the fact of what you've charged for that audit.
Those of you that are in the room that do audits, and I'll use the word audits as a plural. One of the great and common exposures that I see with firms undergoing peer review are those firms that do one audit. For a couple reasons. Usually when I'm doing a systems review, I have to pick one engagement from the highest level of service. That one audit. Now the problem with that one audit, if it is your only audit, it's a one of a kind. And remember what I said, or if a firm has made a mistake causing an engagement not to conform with professional standards on a major item, it's a non-conforming engagement. Well, what does a peer reviewer have before them if they find the one audit having one major item that they failed to complete the documentation on, say a representation letter? They have a blown segment of their entire practice because 100% of their audits were non-conforming. In my mind, and in standards, that leads us almost immediately to an automatic pass with deficiencies report, which is a horrible problem. That's a horrible opening offer. But I just finished, or I'm in the process of finishing a peer review where that is exactly what the firm did. They did one audit, they did a handful of reviews and compilations, and what their problems were not among the reviews and comps. It was the audit that the documentation was significantly flawed. Firm's got to get a PWD, and there's no way to back off from it. So think about that in terms of your practice unit to determine if that is your exposure. If it is, attack that exposure before the peer reviewer attacks it.
So, kind of similar along those lines. Now, let's say that I am one of those firms that really does need to do catch-up. I've never had a peer review before, never gone through any of this process that you've talked about. I've already done the scheduling. I've reached out to my peer reviewer. What should I be doing to prepare? You know, like, what should I be doing to increase my chances of a better review?
Let me start by offering one suggestion. And this is going to sound self-serving, but it's not. I do a lot of lecturing for the American Institute on peer review and on EBP plans. They called me up last week and said, will you be willing to come in to New York City and do a broadcast like this? It's, you know, peer review, are you up to date? I'm pretty sure it's January 24th. I'll check my calendar, but I'm pretty sure it's January 24th. So that's one solution, is self-study. Other thoughts?
I mean, you can go out and get, a consulting review before your peer review. If you've never really done quality control work in any other firm, and you're really not 100% sure of what a peer review is going to be looking for when they come in, that might be your best outlet, is to get somebody in who knows what the system is going to require, to be able to look at your work and determine whether or not you're in compliance with standards. And if not, how do you get into compliance before the peer reviewer comes in?
Shimon in the room is one of the QC people that actually makes a living out of helping firms prepare for their peer review. And there's a number of QC people that are around. Members of the state's peer review committee are certainly competent and capable enough to do a pre-peer review for you and show you how to clean up. Are you paying twice for the same review? Well, no. You're paying for the first inspection to find your mistakes before the peer reviewer does. You're paying for the second one to get a pass. Because that, when I teach, how to prepare for peer review, I start with the question, what is the objective of peer review? And you'll hear people say, well, to comply with law, to comply with professional standards. And the smart guy will always in the back of the room say, to get a pass. That is the objective of peer review. And it really is. Because you don't want to be in that pool of the lower two-thirds, because the Quality Review Oversight Committee of the state is looking at those firms with multiple PWD or failed peer reviews as targets for further enforcement action.
Yeah.
Right, and if you do get a fail or a PWC, you may possibly have additional steps that you may have to do after the peer review in order to get in compliance. So you don't want to be in that situation.
Even with a pass, we usually, there are things called implementation plans. Those come along with a pass. So let's say they found that you were deficient in your CPE, but not to a point that it affected your performance. So they may be asking you to go out and give proof of your CPE or proof of a review afterwards. With a pass with deficiencies, there may be a corrective action plan. That means that you have to then hire the person post-fax. So it's either preventative medicine that you go out and hire somebody beforehand, or you're not going to be able to hide once it happens with your peer review, and you're going to have to do it post.
I mean, you got to remember that the purpose of a peer review is to really bring your level of game up so that you are performing within standards. It's not to hurt or crush you. It's really to make the profession better.
And actually, all of you in this room and everybody on the webcast, you're already taking the first step.
Yeah.
So we commend you for that.
So I'd heard it mentioned before, there are certain firms, after their first peer review, they just go, oh my God, I'm just never going to do a test work, again. How do people make that determination? What's the best way to make that determination if maybe the best course of action is just stop doing audits? Is it just a cost-benefit analysis?
Yep.
Yeah.
It's just as simple as that. I mean, this one man, we went in to do the oversight, and he just looked at us and said, I only do one audit. He didn't do reviews. He did not do anything else. He did this one audit. He was primarily a tax practice. And he turned around and he said, I am just not going to do this anymore. It's just not worth it.
That is not a dumb or shameful thing to do. When I opened our doors in 1986, I did it all. Sole proprietor. Personal tax returns, partnerships, corporations, tax returns, reviews, compilations, audits. And the standards, and even the tax law, maybe not the tax law, but the audit manuals were maybe that thick. Now the volume of knowledge is this big. And our firm isn't that much bigger than yours. 3 partners, 6 or 7 other CPAs, and a couple, 2 or 3 administrative staff, depends upon where we are. And I recognize that I probably could not do it all over again as a sole proprietor, because the body of knowledge is just all-encompassing. It's almost crushing, and I can't imagine being in my 50s or 60s and starting a practice up today. I can imagine being 28 years old and dumb enough to try it, but I'm not so sure I'd do it now that I know what I know. It's all about the math and how much time you have, the benefit that you get out of doing audits. Are you trying to do the audit because it's your single largest client who needs an audit because they're a contractor? High risk engagement, a lot of challenge. Just make sure your hourly rate's there and you're making money, and then you're reinvesting in continuing education, in practice aids. Practice aids, it's a word we never used back in the 70s. When I was, really, we wrote up our own audit programs. Life was simpler back then. So those are some, thoughts in determining cost benefit.
I mean, one of the other things you can consider too is that if you only do 1 or 2 audits, maybe you can get another firm that can actually issue the audits for you, and you can do the underlying work to get to that audit.
And many times at my firm, because we're so large, we do have other firms do the preparation. And, sometimes we do the prep for the big 4 firms. It depends on where the service lies and how big the client is. you know? So you should have some strategic alliances with other firms as well, and that's what we do.
And if you go through that peer review and you find out that you really are good at auditing, do more of it. Compete. Spread the word that you know your stuff. Because I am seeing, especially in the DOL arena, they're dropping like flies. The number of practitioners willing to do a pension audit is starting to they're dropping because they're awakening to the fact that the DOL is tossing them to
The wolves.
the world, to the regulators, not just in New York City, but all over the country. Every state has got firms that are being punished horribly for doing one or two pension audits and doing a bad job at it. And the statistics are pretty much true also in the GAO, HUD, and school district arena as well. So that's your challenge. If you're good at it, do more and charge more.
All right, so I mean, I've determined then that I want to keep on being in the game, want to keep on doing a test work. I'm probably going to have a lot of questions. Who could I call for help?
Whoa, what do you know?
Start with the
How
peer review
convenient.
staff. Yeah, start with the peer review staff. Look up members of the State Society Committee, and they will be willing to at least guide you in the right direction. All of the members of our committee are really dedicated volunteers that will spend maybe a half an hour with you on the phone, giving you some ideas, and then use them as your initial sounding board. And that's a good start. From there on in, look at that AICPA website to see who else is out there doing peer reviews. Ask other practitioners who have had good peer review results. Think about this for a second. You should, if you're going to have an engagement review, means you got quality control systems. You should have, in your intervening years between the peer review year 1 and then peer review number 4, you should have an internal inspection. What's wrong with going out to another firm that has good audit quality work, that is your buddy down the street, and say, how about we exchange services for services? I'll call you in to look at a couple of my engagements, and you tell me what we're doing wrong or right. In turn, if you're strong in a particular area, I'll volunteer some time for your firm to do X, Y, Z if it's the audit area that is your threat. Okay, exchanging services is not a barter, is not a sin. It's a good way to get someone else involved who may not necessarily be a peer reviewer, but if they've undergone a good result, that's a good thing.
One of the other areas that you can look at is on the AICP peer review website. There's a peer review program, question and answers. It's 64 pages. It pretty much goes through the whole program, and it'll answer a lot of the questions that you may have as far as what happens when you undergo a peer review.
All right.
Oh, things to keep in mind. My favorite slide.
Yes, it's your slide.
This is it.
Oh, it is my slide.
Yeah.
Well, let's trade off and we'll each take a different bullet or two. House cleaning. One of the dirty little secrets, and I'll tell you what it is. Your peer reviewer, you're supposed to submit a list of engagements if you're having a systems review to the peer reviewer, and he or she is going to select a handful of engagements. They're going to keep one off the table, but let's say they're going to look at 4. They may take one and make it a surprise engagement, but the other 3, they got to let you know 3 weeks in advance. There is absolutely nothing improper or illegal in the peer review process with grabbing those other 3 and scrubbing the work papers. However, let me qualify that. You know that state law says if you're going to make changes to a work paper file that is outside the
45 days.
45-day
Days.
period, you better have some way of identifying these as additions to the engagement. That way you have the ability to say to the peer reviewer, well, I did fall short in a couple areas, but I corrected myself. The system caught itself. That speaks highly of you. So that's not a bad thing.
Briefing staff. So the peer reviewers, when they're doing a systems review, will actually speak to your staff, if you have staff. And they will talk about the QC process, how you resolve differences of opinion, how you review the file, things along those lines. So you do not want it to be a surprise to your staff that you're going to be peer reviewed, because a peer reviewer may start asking them questions. Also, what I always tell my staff, listen to the question. Don't over-volunteer an answer necessarily, because the peer reviewer might be looking for that. And we actually have one peer reviewer who loves to do that with my staff. And they'll anticipate the question and not even answer what he's truly asking.
Right, what we usually do in our firm is we actually do mock interviews beforehand, basically so that the staff is not afraid of going into a thing. They know what they're going to ask. They know what and we listen to their answers. And we ask them, is that really, we don't tell them what to say, but we ask them, is that really what you've done? The other thing is we say, never assume that the peer reviewer is perfect. There's always questions whether or not, you can always question whether or not a peer reviewer's comments to you are real or not. Ask somebody else. Say, I came across this. Does it make sense to you? Especially when you're talking about the DOL. If there's an employee benefit plan that you're doing and you got hit for certain things, you can ask the question. Go to somebody who does the deal, does DOL audit engagements, and ask them whether or not they think that that's legitimate or not. Because you can always go back and say, I don't agree. And then the peer review committee basically has to come up with, some kind of mediation on this.
Or sometimes you have two peer reviewers having differences of opinions. I think I actually got a question in Australia once. Within 24 hours, one to the other. And I gave them both the same answer. And obviously they were on different pages. So that can happen all the time. I even had it happen on a peer review when I was with the national firm. The peer reviewer was wrong, and I actually showed them where they were wrong. So stick to your guns. If you think you're right and you have the literature in front of you, just do it in a respectful manner.
Yeah, let me give you an example. There's a certain practice aid. We're not supposed to mention practice aids on video because it sounds like we're either criticizing or endorsing a product. But if I were to have a question in the room and said, gee, how many of you use XYZ practice aid? Probably 90% of you would raise your hand. We all know what that practice aid is. Well, it's funny because over the past 20, 25 years, peer reviewers have gotten used to seeing those practice aids in your work papers. And so I've seen many peer reviewers, when they don't see that practice aid or all of the parts of the practice aid included in the work papers, they immediately think that you are deficient in your work. Ain't always so. And I'll give you an example of one of my clients, a guy who's a sole proprietor who's anal retentive when it comes to, just so detailed. And he uses that practice aid for part of his audit work, but he uses his own programs that he has designed that have been tailored to the needs of these particular engagements. And they're great. Let me never say great. They're acceptable. They meet professional standards. I think in a couple of areas I had some criticisms because it didn't necessarily identify the assertions the way I would have liked to have seen them. But he was then able to lead me to another set of work papers where he said, here are the consideration of the assertions for major areas in this memo. So I've got the linkage there, Ray. I've met the professional standard. I understand standards, and he was right, and I didn't make a big deal out of this, where I've seen other peer reviewers go off the edge of the flat earth because they're used to seeing it in a certain way. You have to make sure that if you're going to debate with a peer reviewer, you better be knowledgeable. Don't try and BS your way out of it. You have to be able to point to your working papers as to meeting the documentation requirements of the standards. And I am generally comfortable saying most of the peer reviewers, probably about 80 to 85% of them, are pretty sharp, very sharp cookies, and will know the standards appropriately. So if you're going to debate, as you said, be gentle and be professional, but be accurate, or you'll blow it. Because, you know, the flip side of that particular argument, the flip side of it is when you start debating the peer reviewer, if you're running off at the mouth, you may be digging yourself a deeper hole because you may be demonstrating a lack of knowledge. And that all of a sudden takes that audit and buries it deeper. So, just a thought.
Excellent. And, oh, I'm sorry?
No, go ahead.
Oh, well, I was going to,
I think we should take questions now because we're running a little over time.
yeah.
I'll stay here as long as you guys like.
Okay. All right, gotcha. You can take my microphone then. There we are.
Questions, sir?
Thanks. Just two questions for you. I learned today, not only do I have to email by the 22nd, but I also have to enroll if I'm currently doing reviews. So if, presuming I enroll, tomorrow, how long is it before you actually have to have the peer review completed?
We never got into the peer review year and what you have to choose.
Yeah.
Because you have 18 months to get the peer review done. So that means now you have to now decide what peer review year do you want to have for your firm. Okay? Keep in mind that you have to have the peer review completed. So I'll use my firm as an example. Our peer review year is from July 1st, 2016 to June 30th, 2017. Our peer review has to get started and completed by December 31st of 2017, and it has to get submitted because we're part of the AICPA National Peer Review Committee responsibility. They're our administrating entity. So it has to get there by then. So keep in mind, it has to be within that 6-month period after the end of your peer review. So, year. So you have to figure out where your clients lie and if you're going to have a preponderance of all your clients done. So like if you have 2 clients, all right, and their engagements, so that's another issue that we should get into. Your peer review year is for any audit, review, compilation engagements, preparation engagements that are, their year end is within that period of time. So your client's year ends fall between July 1st and June 30th, okay? It's any of those year ends that are during that period of time, and if you do any agreed upon procedures or projections or forecasts, the date of the report is the guide there, all right? So if you're going to be doing a lot of employee benefit plans, let's say, they're all due October 15th, all right? So for us, it's perfect. I include all of those, and then I schedule my peer review for some time during the month of November so that he can include all of those engagements from that December 31st year end in that peer review. And then the peer review is done by December 31st and off to the AICPA for acceptance by then. So that's what you have to really look at. If you pick a year end that's somewhere in September, that's going to put you somewhere in busy season that you need to have it done by, which is your firm's
Right.
situation. So Ira can speak to that.
Yeah, I mean, you have to basically think about where your busiest point of time is, and then make sure that your 18 months and the requirement to submit your peer review is going to be outside of that, minefield.
So let's say for the sake of argument for your firm, it's your first peer review. And you got to register with the state like right away. Am I correct?
Right.
Right.
So first thing you do is you go to the state accountancy board, register, and say, all right, we're going to undergo a peer review. The next thing you do is you contact the New York State Society of CPAs at the 212-719-8300 number, or if you're lollygagging it and it's March, you call Pennsylvania or some other state, and you say, okay, I'm going to pick my peer review year end as being August 31, 2018. What that says is that any balance sheet dates, any financial statements that have a balance sheet date between September 1, 17 and 8/31/18, those are in play. Balance sheet date, not issue, not report date, balance sheet date. The only exception to that rule deals with things like forecasts or agreed upon procedures engagements, because those don't have a balance sheet date typically. What they have is a report date. Those you get thrown into the mix from the report date viewpoint. But the lion's share of your client base, it's based on the balance sheet date. So now you have an August 31, 2018 peer review year end. And everything is focused on balance sheet dates issued in that 12-month period, and it must be done within 6 months of August 31, 18, which means you got to have your peer review done by February 28th or 29th, 2019. Okay, got that? Very difficult concept for people to remember, but selecting the right peer review end is the most critical issues that new peer reviewers and new peer review firms have to pay attention to. So think about that, be very careful.
I mean, one of the
Yeah,
other
great.
things you also want to just think about too is that, as we said in the beginning, if you just do compilations and preparation services, you wouldn't be included as having to do peer review. But if you do reviews or you do audits and you do compilations and preparation services, they are going to be included as part of your peer review. Just so that, they're not just thrown to the side. They will be part of the peer review.
Okay, so thanks, I appreciate that. So second question, last question for me is that if I'm a sole practitioner and I'm, let's say, no longer going to be doing test work audits or reviews, so I'm going to do tax returns and compilations, right? And then going forward, let's say, I have a 3-year license renewal. And let's say that in 2019, I have a borrowing client that goes over $5 million, and automatically, hey, you got to have a review level statement, and you've been with that client for many years. We expect that, but no previous disclosure of a peer review is required. I was just operating the firm without that requirement. So let's say in 2019 the facts changed. I'm required to do that review. What do? I register then and then go into the full cycle of the
Yep,
peer review? Is that what I am
right.
going
It's
to be,
whenever you
taking
enter
away
into-
from this, really?
Right. When,
That
when,
engagement goes into play, correct?
right.
Okay. All right, thanks.
Hi, thank you, panel. First of all, I would like to say my name is Shimon Einhorn, and I help firms get ready for peer review. I'm also a member of the New York State Society of CPAs Peer Review Committee. I have a question. A pass with deficiencies versus a fail. Can you explain the difference to the firms of what their corrective action would be, if there's any, between a pass with deficiencies or a fail, or the result is going to be the same?
As a general rule,
It's about the same.
the remedial actions may very well be the same, or in both cases, or very similar. The problem is what kind of firm got the fail. If you are undergoing an engagement review and the highest level of work you do are reviewed financial statements, and you got a fail, or you got a PWD. QROC doesn't have a whole lot of time on their hands to look at firms doing comps and reviews. They're not concerned. If you are a firm that's doing GAO or DOL work or school districts or something like that, I can assure you that they will consider looking at you very quickly on the pass with deficiencies. I can assure you they will be looking at you or sending you a letter almost within the year because of the fail report. They are monitoring these failed reports, and they want to catch the errors and see that the firm is remediating very quickly. They're going to send you a letter that's simply going to say, we're watching you. And if it happens again, you've got a problem. If you have multiple PWDs or fails, the AICPA professional standards, after 2, the third time that happens, there is something called the 3-and-out rule, where the AICPA will throw you out. In the case of the regulatory bodies, they don't ever throw you out. They keep coming back at you. So PWDs and fails are not something that you want to play with.
Let me just tell you one other thing too. I don't know how many people here have professional liability insurance. I think one of the questions on there usually is has your firm been peer reviewed? The last thing you want to do is to hand in to a professional liability carrier your peer review and it's a fail. It's not going to do a lot for your premiums.
And it doesn't do much for your credit rating either. If you have a bank relationship and
Right.
you've got a line of credit with the bank, usually they want your peer review report as well.
And any potential clients are going to want your peer review if you have it.
Well, yeah, if you're doing governmental,
Yeah.
you must give them the peer review report.
I had a guy who 3 out of 5 of his peer reviews were either PWDs or fails. 3 out of 5. And he kept on hiring me. I kept on issuing the report that I had to report, and I didn't feel bad about it because I kept on warning him. And I even did the sermon. I said, look, do you understand? This means your engagements are not meeting professional standards. Well, guess what? He got sued. He got sued by one of his clients in another state and lost the suit in part on the merits of the peer review report that was subpoenaed by opposing counsel. So that pass with deficiencies has ramifications. It says you are committing malpractice. That's what that PWD says. And attorneys want to know that stuff because that can turn a jury like that. So talk about the economic consequences.
It's low-hanging fruit for an attorney.
Yeah.
That's probably the easiest way to win a suit.
Consider the report, whatever it is, from your peer reviewer as the most gentle warning you might get. Because there's a lot of other boogeymen in the room, attorneys, regulators among them. Deal.
And really,
Or
if you're going to wind up getting the same comments 3 years from now, that's never any good when we look at it.
Ray, you had also mentioned some sort of deficiency with the representation letter.
Yeah.
And it almost sounded like it would be taken to the report level. Is that...
If a firm has multiple engagements under the review or audit standard that they did not have you said engagement letter or representation?
representation letter, I think
letter.
you mentioned.
Huh?
I think you had mentioned a deficiency in a representation letter.
In a representation letter, that if it's there are multiple cases of engagements that the representation letter was either faulty or non-existent, that creates first of all, the appearance potentially of non-conforming engagements. And a bunch of non-conforming engagements means, in all likelihood, we're going to a pass with deficiency report. Not a good place to be. And then you know what? It's low-hanging fruit. It's easy. How do you not get the representation letter right? I mean, there's samples all over the place, right? So.
I mean, the other thing, too, you got to look at is a lot of times we see firms coming into the program And one of the major things that they kind of screw up on is they don't look at the standards itself. So the big thing was when the compilation and review standard report changed, and people are still using the old compilation and review standard report. That's that's an easy one to to write up.
Could you go back over the inspection standard? You touched on it, but I wonder if you want to provide a little bit more detail.
On the,
Inspection,
like doing your own
yeah,
internal
you have, but
inspections?
yeah, 2 out of the 3 years, there's supposed to be an inspection.
Yes.
Yeah.
So in the 2 intervening years between your peer review, you are supposed to have an internal inspection performed. So that's what I do for my firm. In the 2 to 3 years, we do an inspection. We also do it in the year of the peer review. You can do it also in the year of the peer review. And that's where you get someone to come in independent of you, hopefully, to take a look at the engagements and to see if they've been done in conformity with professional standards. That's what the internal inspection does.
Yeah.
It also looks at your CPE records. It looks at, whatever your QC document says, it uses it as a guide for performing the inspections. In my firm, what we do, and what all of you can do, the team captain checklists are all available on the AICPA's website. And we use those team captain checklists for the engagements and for the systems review. And we use those as our guide for our internal inspection. And we do one every single year. And that's part of the requirements of the peer review standards. So you actually have to give the internal inspection results to your peer reviewer. So, I've gone through and I know there's certain issues that we have. Nobody's perfect. And I write those up in the internal inspection report. And it just proves the fact that our system does find it, and we try to work on improving it.
So that would mean that the sole practitioner would have to have somebody else come in and do the inspections?
Not necessarily. They can do them themselves. But, it's best to have a person that's independent of the process do it.
If you didn't see it the first time, how are you going to see it the second time? That's always the problem. And you know what? It's not just the sole practitioner that's guilty of that. I've done inspections on pretty big firms who have crack QC people, and they missed it. Why? They were too close to the job. They were rushed. They were too close to the guy that managed the job. They thought they knew what they didn't know. I mean, it happens with everybody. You don't know what you don't know until somebody tells you it, right? Oh, that happens.
And even with my own reviewer in-house, we try to rotate the jobs amongst us. And when we do internal inspection, I try not to be involved in the internal inspection process. I'll report it, but I want somebody independent of us to do it.
I know we're running short on time, and you're probably ready to ask another question, but I got to point something out on this slide that's very, very important for everybody in the room. It's the 3rd bullet on the left-hand side, complete and accurate background form. When you register for peer review, and when you provide your listing of engagements to your peer reviewer, gee, what could be so wrong if I leave a couple engagements off the lists? Could I get in trouble for that? You could be sanctioned on an ethics finding for that. And the peer review system is now geared to pick up firms that are not reporting specifically SEC, GAO, or DOL engagements, because the AICPA is doing, they're checking the independent reporting lists against firms to see if firms are claiming those higher risk engagements as they should. There are firms who have been sanctioned with ethics charges. Some firms have been forced to undergo a complete new peer review on a review that's already been done just because they missed reporting, maybe accidentally, or as my mother used to say when I did something wrong, accidentally on purpose. If they're missing something, you gotta screen that list of engagements and make sure it is right, because you sign a representation letter to the peer reviewer that is part of our permanent record, that you said the engagement list was complete and accurate. And if it's not, You get in trouble for that. So I'm sorry, I didn't mean to interrupt you. Sorry.
Are you done with your questions, sir?
So what I guess I'm getting at is that the actual cost of the peer review includes more than just the peer reviewer's fee and the administering fees as well. It's really the cost of inspections, and probably it sounds to me like, and I want your opinion on this, that probably a sole practitioner would probably be well advised to bring in somebody who is independent, who can possibly perform the inspections and also serve as a consultant.
It's advisable.
But then I think Ray had mentioned that, maybe there's ways that you can work with other firms and kind of do things for them and have them do things for you to get the inspection done. So it's an independent review of your work.
Hi, panel. Thank you for the information. If my firm does a review, an audit, am I required to have both a engagement review and a system review?
No, if
No.
you're going to go to the highest level, which is a system review.
Because of the audit.
Right.
The audit puts you into the systems review. If you only do a review engagement, then you can opt for either a system review or an engagement review.
Right. And you also mentioned earlier that one has to pick a particular year. You mentioned something like August 31st, and it goes from that particular year to the, I guess, July 30th. That'll be the year that you are looking to do this particular action. And then 6 months from August 31st will be the time that you need to have that particular review done, correct?
Right.
Now, how do you mention that is very critical that you choose a year end, if I could call it that. How do you actually do that?
It depends on when you think those reports will get issued. So in my firm, our year end goes to June 30th, right? So that's any audit that we've done through June 30th. Well, the June 30th audits normally are not-for-profit audits, all right? And most of them are getting, extended or whatever. But we have enough other audits that take up the census, so that he's got enough to pick from. Well, if your only audit is on June 30th, and it's not going to be done by December 31st, because you've got the extension on this non-for-profit to another period, then there really is nothing for the peer reviewer to look at. So that's like a defective year end for you. So you have to make sure that your audit client is going to be done within the 6-month period after your year end.
It has a s-
You also have to keep, in fact, the 18-month rule when you first register, that you have 18 months to do it. So you can pick a peer review year end within that period, but you got to make sure that the review is complete within the 18
Yeah.
months.
And when you're saying pick, I do pick when I register, or when I do, when the actual picking takes place?
When when you start to register with the State Society of CPAs, the administering entity, they will give you some guidance based upon or the peer reviewer that you might engage might give you some guidance. One of the things that I see firms mistakes they make all the time, which is really dumb. You say, all right, I want to get a jump on this. I'm going to make my peer review end November 30, 2017. And then, but all of a sudden, and all I have is comps and reviews up to that point, so I'm going to have an engagement review. And then, knowing full well that I'm going to have a December 31, 2017 audit of a contractor. Well, even though that December 31, 2017 is outside the scope of the engagement review, it's going to create a need for an accelerated systems review. So you're going to have your next peer review done within the next year on a systems level. So why pay for 2 peer reviews? Pick a December 31 year end or a January, February, or March 18 peer review year and have that audit included in the systems review inventory. Okay?
Great. I'm sure there's a lot of questions, but I really can't take too much time. One last question. I need to notify the state that I fall under these guidelines going forward. The notification is via email, from what I read. Is it a simple notification? Do I need to include other than the fact to say that I will be part of this program, or is there anything else that I should be aware of?
I-
You just have to tell them that you're going to be doing a test work.
I think so. I
Yeah.
think, well, we just re-registered our firm, so there's a form, I think it's 6R on the New York State Education Department. It actually is a form where you make an affirmation of whether or not you have attest engagements. So don't quote me if it's New York State 6R or whatever. If you go on the state education site, they are very user-friendly. So you can go through the accountancy page, and it will tell you what forms to file. Though they don't have this October 23rd law up there yet.
Right.
So that's the one thing that's a little bit
Yeah,
disappointing.
because it only tells you, all you need to do is notify, but notify could mean, I don't know what.
Right, and I think there is a form, there's a form that you have to file annually with them. Look at the annual form if they've updated that, and on that annual form, it does talk about whether or not you need to have a peer review. And then there's a secondary form that you file along with it.
My guess is that once you send them the email that you're a part of the system,
They'll
that the
send
forms
you.
will come to you very quickly after
Right.
that.
Okay. I guess
They,
that was
they
my
have an
question.
excellent staff. They only have a few people up there, but they usually are excellent.
Thank you.
And we'll get back to you.
Thank you.
Okay, we have one question from the web. Is a New York City annual RPIE filing what you consider a New York City certiorari?
No, it's the TC 309 and the TC 201. Those are the New York City certiorari forms. The RPIEs are just annual filings that are done for New York City purposes, but they're not audited. Where it's possible that these TC 201s could be audited. If you're submitting TC 309 with the 201, then you're doing an audit.
Any other questions?
Love this, by the way. Love a lot of questions.
Hi, when you first started out, you were talking about when they first come into the firm looking for, I guess it's the control management system, or whatever that is for that overarching
The
description.
quality control
Yeah.
document.
What exactly would everyone be looking for? What are we talking about there?
It's basically how your firm operates. It's what you do in order to make sure that what you're submitting to a client or to a bank or anything is basically under professional standards.
Okay,
And
so-
what controls do you have to ensure that that's happening?
But you said-
Basically, it follows what's called Squash 8. There are actual quality control standards out there, and there are 6 pillars to the quality control standards. Tone at the top, relevant ethical requirements, so that's client acceptance and
Right.
continuance, your HR function, your engagement performance, and then your monitoring function. So you have to write up how you're complying with each one of those aspects of that quality control standard. And there are practice aids out there that will give you those quality control standards written up in a format. I'm sure if you Google it, you'll get a couple of quality control documents also online.
You know,
But-
in the past,
They had a checklist for
there was a
it.
checklist for it, and if the peer reviewer filled out the checklist, they can use that as their QC document. They took that requirement, they took that option away now. It says that the firms have to have a formal QC document when you walk in.
So that's the policies and procedures that you were talking about earlier.
Exactly.
Right,
For
but
policy.
covering the 6 quality control elements.
Elements.
Okay.
Okay, so you can buy that, I think you can go online at the AICPA, or there's also that, that
Other
Pe-
practices.
other
The
practice
other
aids that I
Craig
can't-
that we can't mention, but they also have a whole manual around it as well.
and they'll give you a document that's in Microsoft Word, and you can play with it and
Okay.
make it conform to your, and they also have at different sizes, sole proprietor, 2 or more professionals, and then
Yeah, and
big
they-
firms.
The only thing I will say to you, though, is if you're putting together a QC document, Don't put stuff in there that you're really not going to do,
Right.
because that's what's going to kill you.
Right. We have a client that, you know, they have this policy and procedures manual that they give us every single year. And we say it's the greatest work of fiction because the client doesn't follow
Right.
that policies and procedures manual. It's the same exact thing. Think internal control write-ups. That's what this is. This is your internal control write-up.
Okay, thank you.
I'm just going to say that the AICPA has as was previously mentioned, has a quality control document for small firms, and it's really quite good. So you might want to take a look at that. You don't have to buy any form, anything from anybody else. It's pretty complete.
You can give it a try, but you know what, Abe? I think they've been taking it off their website. Yeah, so you may want to try something called Wayback, which brings you back to old websites, and they may have the AICPA's website there.
Yeah, go Google CPA
Yeah,
quality control
Control
documents, and you don't know, somebody may have their quality control document up there. You can pull it down for free off of somebody else's website, or you know, the New York State Society has kept that additional library and reference library.
Yes.
And sometimes they keep some of the old stuff on there too. So back when that thing was a free practice aid, it's still there. That's free pickings.
Yeah.
Huh? The
Yeah.
NCPA did.
Yeah.
But I'm telling you, the State Society may not have.
Can I suggest that the New York State Society put it back up? I mean, it really was very, very helpful and provides really good
Yeah, but
guidance.
they'll get in trouble because, see, I did the oversight of it, and they have to keep current with what the AICPA has there. But we can talk about it.
Well, if there are no more questions, I want to thank everybody for coming over here tonight. I want to thank in particular our panelists. And thank you so much, and have a great evening, everyone.